Good morning, venture capital. This is Metagame, and today we're chasing $300 billion that went in and asking where the results went. $300 billion in, 95% out. Both numbers are true. Both numbers are this quarter, and nobody on your cap table wants to talk about what happens when those two numbers meet. Let me set the scene. Q1 2026, global venture capital deploys $300 billion. 80% of it, $242 billion, flows into AI. KPMG's quarterly pulse drops, and the headline number is the kind of thing that makes growth equity partners forward emails to each other before breakfast. Average projected U.S. enterprise AI spend over the next 12 months, $207 million per organization, nearly double the prior year. Globally, 186. 79% of leaders still call AI a top investment priority. The hyperscalers confirm it in cash. The 4 major U.S. cloud providers are tracking towards $675 billion in AI infrastructure spend this year. Google Cloud Q1 up 63%, $20 billion. Azure up 40%, accelerating from 39 the quarter before. Demand exceeds supply at the infrastructure layer. Picks and shovels, clearing the shelves. Now flip the tape over. MIT's GenAI Divide study, same quarter, 95% of enterprise AI pilots deliver zero measurable P&L impact. Zero. Not underperforming, not early innings. Zero. S&P Global, 42% of companies abandoned most of their AI projects in 2025. 42%. In any other software category, that's a career-ending number. In AI, it's a Tuesday, and then the one that should be tattooed on every investment committee whiteboard. KPMG's own data, same report, same quarter, 65% of leaders now say they cannot scale AI use cases, up from 33% the prior quarter. That's not a trend. That's not a wobble. That's the scaling difficulty number doubling in 90 days. A regime change disguised as a footnote. So here's the picture. Capital is accelerating. Operational absorption is decelerating. The gap between what enterprises are spending and what enterprises are actually believing has never been wider in the history of enterprise software. Not in cloud, not in mobile, not in SaaS. Never. And the market has stopped trying to resolve it. Let me explain why that should terrify you and why it should also excite you, depending on which side of the bifurcation your portfolio is sitting on. Because the venture market, your venture market, is not pricing in the 95. SEC Form D, Q1 2026, $256 billion raised across 1,003 deals. Deal count down almost 12% versus Q4. Capital up over 14%. 41 mega rounds at $1 billion plus captured $193 billion. 76% of all the capital in the quarter went to 41 companies. Sierra raises $950 million at a $15 billion valuation, claiming 40% of the Fortune 50 as customers. Factory closes $150 million at $1.5 billion for enterprise engineering agents. Beautiful logos, beautiful narratives, beautiful marks. Marked against what exactly? Marked against an enterprise customer base where 95% of pilots fail, 42% of organizations are walking away, and 65% of leaders are openly admitting they can't get this stuff into production. Every dollar of that $300 billion is implicitly underwriting a single bet, that the 95 collapses, that on a 3 to 5 year horizon, pilot failure becomes pilot success, abandonment reverses into adoption, and today's $15 billion Sierra mark looks like a steal. If that bet pays, today's marks are cheap. If it doesn't, the entire AI application layer is mispriced against a customer base that physically cannot operationalize what it's buying. Most funds have not priced that bet explicitly. They have priced it implicitly by writing the check and hoping. Hope is not a portfolio construction strategy. Hope is what you tell your LPs when you don't have one. Let me break this down for a second because it matters. When KPMG says scaling difficulty, they don't mean engineers are tired. They mean the enterprise has bought the tool, run the pilot, seen the demo, briefed the board, and then hit a wall made of skills gaps, security review, data quality, and change management. 62% cite skills as the #1 ROI barrier. 63% still require human validation on every AI output. 80% flag cybersecurity as a deployment blocker. The technology arrived. The organization didn't. Back to the story. Because here's where it gets interesting for anyone actually paying attention. The bifurcation is not subtle. The infrastructure layer is monetizing. Azure 40, Google Cloud 63, 675 billion in capex. The application layer is not absorbing. 95, 42, 65. The shovels are selling, the miners are starving, and the venture market is funding both sides as if they're the same trade. They are not the same trade. So what do you do with this if you actually run capital? 4 questions. Memorize them. Question 1. What is your portfolio's pilot to production conversion rate? If 95% failure is the market baseline, a fund whose AI portfolio companies are converting customers at 10% is outperforming the market by a factor of 2. Most LPs are not being shown this metric. They should be. If you have it, lead with it. If you don't, find out why your founders aren't tracking it. Question 2. Are you funding the gap or funding into the gap? Big difference. Companies selling deployment tooling, integration services, evaluation frameworks, human-in-the-loop validation, change management, those companies get paid whether the pilot succeeds or fails. They monetize the 95. Companies selling end-state AI outcomes, autonomous agents, full-stack automation, replace the workflow plays. Those companies need the 95 to come down. One business model is short the gap. The other is long it. Know which one you own. Question 3. Where is the skills gap arbitrage? 62% of enterprises say skills are the #1 barrier to AI ROI. That is a services, staffing, and training tailwind that does not require the underlying models to get smarter. It just requires humans to deploy them better. PE has noticed. Venture, for the most part, has not. There is a category here that gets dismissed as not venture scale, and it is quietly building distribution into the exact accounts your portfolio companies are trying to penetrate. Question 4. What is your abandonment exposure? 42% of companies walked away from most AI projects last year. If your Series B or C portfolio companies have ARR concentrated in pilot stage deployments at large enterprises, you have churn risk that is not priced into the mark. The revenue is real. The retention is a question. Ask it before your LPs do. Here is the part nobody on Twitter wants to say out loud. The funds that treat the spending number, 207 million, 675 billion, 300 billion, as the only signal are writing into a market that is quietly rotating from AI everything to AI that demonstrably works. Those funds will own the casualties. The funds that treat the failure number, 95, 42, 65, as the only signal will miss the window where the gap closes and today's marks look like 2009 Series A pricing. Those funds will own the regret. The play is neither. The play is to know which side of the bifurcation each individual check sits on and to mark the portfolio honestly against the side it's on. Spending side companies, you underwrite to the infrastructure curve. Believing side companies, you underwrite to the absorption curve. They are not the same curve. They are not even the same chart. Half the market is doubling down, half the market is quitting. There is no middle lane in this quarter. The CFOs writing $200 million AI checks and the CIOs killing 42% of their AI projects work in the same buildings. Sometimes they are the same person. The contradiction is not getting resolved at the customer. It is getting exported in real time to your cap table. So back to where we started. 300 billion in, 95% out. Both numbers, this quarter, on the same tape. The question is not which number is correct. They both are. The question is which number your portfolio is implicitly betting against, and whether you can defend that bet to your LPs in the language of pilot conversion, deployment economics, and abandonment risk, instead of the language of hope. The funds that close that gap on paper before the market closes it in reality are the funds that come out of this cycle with the marks intact. The rest will spend the next 3 years explaining why $207 million of average enterprise AI budget somehow didn't show up in their portfolio's net revenue retention. Pick your side, price it explicitly, and know, before next quarter's tape lands, exactly which one of those 2 numbers you are actually underwriting. That's our Venture Capital podcast for today. If you learned something new, tap 5 stars and follow our show. Thank you for listening to Metagame.
Grab news. Thomas.